Hi everyone, it's Sohana and you're at the front of finance. This is the course Investing 101 Part 4, The Mechanics of the Stock Market. So let's get started. Through today's session, we will explore the stock market in further detail, including its regulators as well as its instruments. So now I will be elaborating upon what regulators and instruments are further into the module. But to give you a quick overview, this module is definitely a lot more technical than our previous modules, primarily because we're really diving into how the stock market operates. So to give you guys a quick recap, we have discussed the supply and demand dynamic in the previous modules. To run you through it again, the law of supply and demand basically states that when we have more buyers or higher demand, then the price of a commodity or the price of a stock rises. And when we have lower demand or fewer buyers, then the price of our commodity, or in this case, the stock, will fall. Now, this is a very important dynamic on the basis of which our stock market does run. So it's very important to understand this dynamic in order to truly comprehend how our stock market operates. So now let's get started with stock market indices, also known as indexes. Stock market indices are basically performance indicators of stocks in their respective stock exchanges. So if you have looked into investing and finance in stocks earlier, you've probably heard of terms like Nifty and Sensex, and you're probably wondering what this is. Nifty and Sensex are indeed indices, and they're indices of specific stock market. In this case, Nifty is an indicator of NSE and Sensex is an indicator of BSE, both of which are the primary stock exchanges of the Indian market. So indices are indicators which group together top performing stocks to create an index. When these indexes grow or fall, it basically indicates the performance of the stocks within the index. To sum it up, the indexes reflect the performance of the specific group of stocks or the stock market as a whole, and the stocks that make up the index are usually the top performing stocks of that specific stock market in that period of time. So how exactly do these indexes select their stocks? There are a variety of factors that influence this. The first factor that's been spoken about here is market capitalizations, and basically a company that has a higher market cap is likely to be performing well, and so the price of their stocks is probably expected to rise as well. Secondly, we have price, and basically companies with higher stock prices will be higher up in the index and thus grouped together. There are also certain other indices that I've spoken about here, which include S&P 500 and NASDAQ, so you can definitely pause the video to have a look at this. Alright, so now we're moving on to a very important part of the module, which is stock price movements. Stock price movements are very important for you to understand and know of if you practically do want to invest in the real world, because when you understand stock price movements, you will be able to determine which investments can result in potential profits for you. To clarify, stock price movements are basically changes in the prices of individual stocks over time, which drive buying and selling decisions. So let's have a look at the many factors that influence these changes in stock prices. Firstly, we have company performance. Positive or negative news related to a company's financial results, new product launches, management changes, or legal issues can significantly impact its stock price. So now to give you guys a quick example, you probably remember in 2015, Maggie was exposed and Maggie was found to be using lead in their products. So they were banned for a short period of time. Not only did Nestle face a lot of backlash, but their stock price also did fall significantly because the presence of lead in their product is an example of a legal issue, and thus an example of how company performance can influence a company's stock price. Next, we have industry and sector trends. You've probably heard a lot of people say that right now is a good time to invest in green energy companies or companies that support the production of EVs. Why? Because these industries are currently on the rise. Renewable energy and electric vehicle companies are doing significantly well, and so therefore an industry and sector trend obviously influences how a certain company or firm within that industry will be performing. And with such industries growing, that means that the companies within the industry will be growing as well, and therefore their stock price is likely to rise. Then, of course, we have certain broader economic factors such as the overall GDP growth, controlled inflation, and employment levels, because they definitely do lead to consumer confidence and therefore higher stock prices. Then again, these factors are not relevant or specific to certain companies, but the market or the economy as a whole. Now, this is something that's actually quite interesting, investor sentiment, because this involves the overall psychology of investors and how certain biases, certain preferences, and certain opinions of certain investors plays a role in the stocks that they choose to buy. And therefore, positive investor sentiment, which means when they are supportive of a certain stock due to their own opinions or biases on that stock, it can drive buying activity and push stock prices high. Then we have the supply and demand dynamics, which we spoke about in the first slide, and lastly, news and events. Because news and events, both company specific and market wide, can have a substantial impact on stock prices. To give you an example of this as well, about a year ago, Cristiano Ronaldo was seen in an interview rejecting or refusing to drink Coke when offered and instead drinking water instead. Now, Coca-Cola faced a lot of backlash for this one event, and their stock price significantly dropped, obviously for a short period of time, but it did drop for this short period of time, and that is a clear example of how news, events, and speculation about a company can have an impact upon its stock prices. Alright, now we're going to be talking about the types of trades, and this part of the module falls under those technicalities and those technical concepts that I was talking about at the very beginning of this module, because this is definitely something that's a little bit more technical and not something that very beginner investors necessarily have to be aware of. But at the same time, like I said earlier, it's always recommended to have some extra knowledge. And we have really simplified these concepts here, so I would recommend that you continue watching. Alright, so the first trade type that we have is the market order. This is the most basic type of trade, and you basically buy or sell your stock at the best available price in the market, and the trade is executed whenever you want it to. It's executed immediately after you give the command. Then we have the limit order. Within the limit order, you basically set a specific price at which you want to buy or sell your stock. So now your limit order can be further divided into the buy limit order and the sell limit order. Within the buy limit order, the trade will be executed at or below the specified price. Now I really want to emphasize upon the word below here, because when your trade is executed at a price below the one that you have specified, that basically means that you're getting your stock for a cheaper price, and therefore you're saving up that little margin between what you had initially decided you will buy the stock at and its actual price. So this does result in an indirect profit. And then of course we have the sell limit order, wherein the trade will be executed at or above the specified price. Again, emphasizing upon the word above, if you do end up selling your stock at a price higher than the one that you have initially specified, then your profit will be even higher. Okay, now we have the stop order, which is used to limit potential losses or protect profits. So again, the stop order can be divided into the buy stop order and the sell stop order. The buy stop order is placed above the current market price. It becomes a market order when the price rises to or above the specified level. So basically this ensures that you don't end up buying your stock at a price that is higher than what the current price is, because then obviously you're paying more than you would want to. The sell stop order, on the other hand, is placed below the current market price, and it becomes a market order when the price falls to or below the specified level. So again, it basically ensures that you don't sell your stock at a price lower than the price that you bought it at. So it ensures that you don't make some sort of a loss from that share. Then we have the stop limit order, which basically combines the stop order and the limit order. When the stop price is reached, the order becomes a limit order and it will only be executed at the specified limit price or better. Now we have the MOC, or rather the market on close order, which is executed at or near the closing price of the trading day, which allows you to buy or sell your stock at the market price just before the market closes. So investors primarily use this type of order when they have conducted some sort of analysis and made some predictions about what the price of the stock will be just before the market closes, and therefore they make use of this order in order to buy the stock at that specified time. Then we have the day order. A day order is valid only for the current trading day. If the trade is not executed by the end of the day, then it expires. And then of course we have the GTC, or rather the good till cancelled, which is an order that remains in effect until it is manually executed or cancelled by the investor. And that brings us to the end of today's module, where we basically unravel the mechanics of the stock market in terms of indices, of the various factors that influence indices, as well as the different types of trades. This module has definitely set a very good foundation for your next module, where we will be discussing the actual practical process of investing and how you as a teenager or as a beginner can set your investment goals, set some strategies, and actually begin investing in the real world. So thank you for tuning in today, and definitely do come back for the next module where we dive into the actual investment process.